Hey, welcome to Retirement Made Easy. On today's video, we wanted to talk about how we can save taxes on our Social Security income. We're going to talk about the ins and outs of how they tax Social Security income, and then we're going to end with a case example of a retired couple collecting Social Security and paying zero income taxes on their Social Security benefits. So let's first talk about the good. When it comes to Social Security income, there's only 9 states out there, as I record this video, 9 states that could tax your Social Security benefits. So from a state level, Social Security benefits are very, very tax efficient and tax-free. 41 states, so the vast majority of the people watching this video, you're going to pay 0 state income taxes on your Social Security benefits. An update, as I'm recording this video, the big beautiful bill just passed the House and moved into the Senate. And the provision that changed how Social Security was taxed was actually tossed out. So it didn't make the final draft of the bill. A lot of people were hoping that taxes were going to be eliminated on Social Security income, but that didn't make the final draft or version of the bill. So it's going to be business as usual. And we're going to go through provisional income and how they come up with taxes on your Social Security income. So let's do that. This is provisional income. So it's important to understand how they come up with provisional income and what your own provisional income is to determine how much of your Social Security income is going to be taxable. It also helps with our planning. So provisional income for most people is just adjusted gross income plus 50% of your Social Security benefit. You'll notice it does include tax-exempt income and excluded foreign income, which, in my experience, doesn't apply. Those middle two don't apply to 90% of the population. So, but that's the formula for provisional income. Again, for most people, it's going to be your AGI plus half of your Social Security benefit. Now, combined Social Security benefit if you're married, of course. So what do we do with that? Once we know your provisional income, what do we do with that number? Well, there's a table which we're going to go through next together, and you'll see how much of your Social Security benefit is taxed based on where you fall in this table. So it's broken up into 2 parts. Married filing jointly is here at the bottom, and every other filing status is at the top. So for example, we look at your provisional income, or we, meaning the IRS, looks at your provisional income. And for a couple married filing jointly, if provisional income is below $32,000, all of your Social Security income is tax-free. Once you get provisional income between $32,000 and $44,000, you can see it bumps up. So up to 50% of Social Security income may be taxable. And then more than $44,000, up to 50% of Social Security may be taxable. Now, you can see the tiers, the limits, the income limits are lower for every other filing status, like single, head of household, married filing separately. But these are how they stand today. This last changed in 1993, and these figures that you're looking at are not, unfortunately, indexed with inflation. And if you've listened to the podcast for any length of time, you know that personally, I've been a critic of this. I think these figures, these income amounts in 1993 may have been decent, an acceptable standard back then. But, we're looking, over 30 years later in 2025, as I record this, I just think they kind of missed the mark by not indexing these figures with inflation. So that's a change that I was personally hoping for. So we now understand what provisional income is. We understand this chart of how you might fall and how much would be taxable. Let's look at a real life example of a retired couple. We're going to assume they're 65 years old. They have no wages because they're retired, and they're collecting Social Security income. So we're going to do that next. Okay, so this is our couple. This is our nice 65-year-old retired couple. And this is updated as of the new big beautiful bill that was signed into law on July 4th of 2025. So we're going to assume that their Social Security benefits are $36,000 a year. That's $24,000 a year for John, and Jane's Social Security is $12,000 a year. And Social Security tells us that the average benefit for a couple in 2024 was $3,033 per month. So we're going to assume it's just $3,000 a month. We're just going to round that. So that's $36,000 a year for John and Jane. So we've got that in, and you can see right below taxable Social Security for a 65-year-old couple. If all they had was Social Security and it was $36,000 a year combined, none of their Social Security would be taxable. So for John and Jane, we're going to assume quite simply that there's no taxable interest. So they don't have a brokerage account. They're not earning interest at a bank anywhere in CDs or a money market or any of that, just for simplicity's sake. Also, they're not receiving any qualified or non-qualified dividends. And a lot of people would just stop here. We're also assuming there's no taxable pensions or annuities that they're receiving. So if the 65-year-old couple, John and Jane, was receiving $36,000 a year in Social Security, they would pay zero income taxes, federal income taxes. And a lot of people make a mistake and they stop here. And I'm also going to try to assume something else, that they're working with some type of financial advocate. Hopefully it's a fiduciary that is saying, okay, John and Jane, don't stop here. Yeah, if you just collect your Social Security and you leave everything as is, you'll pay zero federal income taxes, but you can also do more. So what I'm going to assume is, let's say they either decide to take an IRA distribution or they decide to do a Roth conversion. And so for this couple, I'm going to assume they just do a distribution out of their IRAs. So let's say that they take out $33,948 for the year. Now, you'll notice what that causes is now more of their Social Security is subject to taxes. So $12,756 is subject to taxes. However, and you can see their total income and AGI becomes $46,704. But remember, they have a standard deduction and there's an enhanced senior deduction as a result of the big beautiful bill, $12,000, which is $6,000 each. So their standard deduction, $34,700, plus the enhanced senior deduction of $12,000, you can see their taxable income is only $4 at that point, and their total taxes are zero. So if they would have just stopped there with the $36,000 of Social Security income, again, they would have paid zero federal income taxes. But by doing this, by doing an IRA distribution of $33,948 on top of their Social Security, it enables them to still pay zero federal income taxes. They could have also done a Roth conversion for $33,948 and paid zero federal income taxes. So if they go above that, if John and Jane were to take more than the $33,948 out of their IRAs or included maybe a Roth conversion, let's say they wanted to do 20,000 of Roth conversions. Now you'll see now more of their Social Security is taxable at that point, and they're going to owe taxes. Their total tax is now $3,963 because they decided to do this Roth conversion on top of taking $33,948 out of their IRA as a distribution. So there is a tipping point where the more that you take out of your IRA, the more Roth conversions you do, inevitably it makes your Social Security benefit become more taxable. So in their case, we'll actually just remove this Roth conversion, and therefore it brings them back down to zero. So their total income taxes, you can see is here, is zero. So I hope this has been helpful. So what did we learn today? At least 15% of your Social Security benefit will always be tax-free. But how we come up with our income plan in retirement dictates how much of our Social Security benefit is actually taxed. And we can plan ahead and plan for our success. So I hope this video of Retirement Made Easy has been helpful. I'll see you next time. And remember, always dream big. And if you want to learn more about how we help people plan for a successful retirement, visit our website, RetireStrongFA.com.